Task 1b, question 1b solution. So we've got two properties. We've got Baldwin is bought at $470,000 in 2010 and Richmond was bought at $250,000 in 2010. So this question has asked us to explain the value at which each building should be valued in the balance sheet according to the conservatism principle. So in this case, what we need to remember is not just the cost prices of when these properties were bought, but also their current values. So for Baldwin, the current market value is $420,000, and for Richmond, the current market value is $540,000. So how should we value these properties based on conservatism? Should we take Baldwin down to $420,000, and should we therefore also increase Richmond to $540,000, or should we leave them the same? Should we change one and not the other? First thing we're going to need to do is remember what conservatism means. So the conservatism principle says we must use caution when preparing financial reports. So that word is really important, caution. What that means is we recognize any loss when it is expected to occur, but gains are only recognized once they are certain, by which that means once they've been earned or received. So applying that logic to the Baldwin and Richmond properties, let's look at Baldwin. Bought it for $470,000. Its current market value is about $420,000. So that's actually a loss. We're going to expect a loss of $420,000. So we might keep that one at or revalue that one to $420,000 because it will recognize an expected loss. Looking at Richmond, we've actually made a $290,000 gain since we bought the property. So what we want to do with that one is, do we recognize that gain today or not? And we're going to say we don't, because that gain is not certain. It might occur in the future, but if we actually haven't sold the property, then we haven't actually earned that gain and gotten any money. So we are not going to record Richmond at $540,000. So we will record the loss in summary of the Baldwin property, but we will not record the gain for Richmond because gains are not certain until they're earned. So we'll leave Richmond at $250,000. Formulating an answer here, we're going to follow our I for identify. In this case, though, we actually don't need to do it because the question has said the conservatism principle is the one we're applying, so there's no marks for that. But we will define it. We will say caution must be used when preparing reports, so losses are recognized when expected and gains are recognized only when certain. So now we need to get to the relate part. How do we apply this? So in this case, we said the Baldwin property should stay at its $420,000 cost price. Oh, sorry, the Baldwin property should be valued at $420,000. That's actually the market price, because this recognizes an expected loss of $50,000 from the original purchase price. What about Richmond? We said let's value that one at $250,000. Let's keep it at what we bought it at. And not record that $290,000 gain in value because it actually is not certain, it hasn't occurred yet, and we haven't sold the property. Let's look at our marks here. This is a 3-mark question, so we're going to get 1 mark for the definition of the conservatism principle, and then we're going to get 1 mark for applying conservatism to the Baldwin property, and 1 mark for applying it to the Richmond property.